Hey, welcome to the Explainer. Today we're going to pull back the curtain on the U.S. federal income tax system. The whole goal here is to take all that confusing tax jargon and, make it simple, turn it into stuff you can actually use.
I mean, who hasn't been there, right? You look at that top line number on your paycheck and you're feeling pretty good. And then you see what actually lands in your bank account and it's like, whoa, what happened? By the end of this quick explainer, you'll get exactly what's going on in that gap and why. All right, so let's just dive right in. To really get a handle on how your taxes work, you gotta first understand this one single idea that the entire system is built around.
And that big idea, it's all wrapped up in one single word: progressive. Yep, the U.S. federal income tax is a progressive system. And all that really means is that higher tax rates get applied to higher levels of income. It's really built on this concept of ability to pay.
So, what does that actually look like in the real world? Well, check this out. The data shows the top 1% of earners, they end up paying almost 46% of all federal income taxes. That is a direct result of that ability to pay principle we were just talking about.
Okay, let's keep building on this. Now we're going to crack open the tax code itself and look at some key terms you absolutely need to know. Seriously, once you get these down, everything else just kind of starts to click.
So we've got progressive taxes, right? They're based on your income. A regressive tax is, well, it's pretty much the opposite. A perfect example is sales tax. Just think about it. Whether you make 30 grand a year or 3 million, you're paying the exact same 7% sales tax on, say, a gallon of milk. But that 7%, it's a much bigger piece of the pie for the lower income family. It puts a way bigger burden on them.
All right, next up, the two main ways the government taxes your money. First, you've got income tax. This is the one we all think about. It's the tax on your salary, your wages, any interest you earn. But then there's capital gains tax, which is different. That's the tax you pay on the profit you make when you sell something valuable, like a stock or a house. It's basically a tax on your investment profits.
Okay, but here's where it gets really interesting. The tax code gives a special deal for what's called long-term capital gains. If you hold on to an investment for more than 1 year before you sell it, the profit you make gets taxed at these special, much lower rates. This is basically the government's way of saying, hey, we want you to invest for the long haul, not just flip things for a quick buck.
All right, listen up, because this is probably the single most misunderstood concept in all of taxes. For real. People hear they're in the 24% tax bracket, and they freak out, thinking their entire income is getting taxed at 24%. No, that's not how it works. Your marginal rate is just the tax on your very last dollar earned. And your next one. Your average rate is what you actually pay on your total income.
Okay, theory is great, but let's make this real. We're going to put all these ideas together and walk through an actual calculation. This should make everything crystal clear. So, it all breaks down into 3 basic steps. You start with your gross income, that's every penny you earned. Then you subtract a few specific things like retirement contributions, and that gives you your adjusted gross income, or AGI. Finally, you take out your deductions, and what's left is your taxable income. That's the number that actually gets taxed.
So let's put some numbers to this. Imagine a single person with a taxable income of $175,000. Now, remember those tax brackets we talked about? The best way to think about them is like a series of buckets. You have to fill each bucket to the top at its specific tax rate before any money spills over into the next higher rate bucket. Let's see how it works for this person.
Okay, here we go. First, we fill up that first lowest bucket. The first $11,000 of their income gets taxed at that nice, low 10% rate. So that's a tax of $1,100. Easy enough. All right, bucket 1 is full. Now the money spills over into the next one, the 12% bracket. So all the income they earned between $11,000 and $44,725 gets taxed at this rate. That adds another $4,047 to their tax bill. You see the pattern here, right? We're just filling the buckets one by one. Now for bucket number 3, their income up to $95,375. That chunk falls into the 22% bracket, which adds another $11,143 in tax. And finally, we get to their highest tax bracket, their marginal rate. Every single dollar they earned above $95,375, all the way up to their total of $175,000, is taxed at that 24% rate. This last piece of the puzzle adds $19,110. Okay, so let's add it all up. Their total tax comes out to $35,400.
But here is the most important part. Even though they're in the 24% marginal tax bracket, their average tax rate, that's their total tax divided by their total income, is only 20.2%. See, it's a huge difference from that scary top number.
All right, so we've totally demystified the math, which is the hard part. Now, let's just quickly touch on the practical side, actually filing your tax return.
Okay, this is a huge question, especially if you're just starting out or maybe didn't earn a ton of money one year. Do I even have to file a tax return? And luckily, the answer isn't some big mystery. The IRS gives you a really straightforward, numbers-based answer. So here's the general rule of thumb. If your total earned income for the year is less than the standard deduction for your filing status, you probably don't have to file. But, and listen, this is a big but, if you had any taxes taken out of your paychecks during the year, you should absolutely 100% file. Why? Because you'll get that money back as a refund. It's your money.
Okay, and finally, let's get to the best part, the really empowering part. Let's talk about how you can take all of this knowledge and use it to your advantage to make some really smart financial moves. Now, before we go any further, we have to get this one thing straight. There's a huge difference between tax avoidance and tax evasion. Tax avoidance is totally legal. It's just using the rules of the tax code to lower how much you owe. It's smart planning. Tax evasion, on the other hand, is illegal. That's lying or cheating to not pay taxes you actually owe. What we're talking about here is being smart, not being a criminal.
So let's look at 3 super common and smart strategies. First, retirement accounts, like a 401k. Every single dollar you put into one of these reduces your taxable income for the year. It's like getting an instant tax break just for saving for your future. Second, just like we talked about, be patient with your investments. Holding them for more than a year unlocks those much lower long-term capital gains rates. And third, something really simple. Keep good records. Whether it's for money you donated to charity or business expenses, having good records makes sure you can claim every single deduction you're legally entitled to.
So let's wrap it up with this idea. Your taxes aren't just some bill you have to pay every year. They're a core part of your financial plan. Understanding the tax code isn't just about following the rules, it's about strategy. It turns taxes from this thing you dread into a tool you can use. So the real question is, now that you know the rules of the game, are you playing it as well as you could be?